So yesterday was a bit interesting.
Correct.
Yeah.
Correct.
So I'm talking again with Owen Lee. Um, yeah, this was it was an interesting day. So the and this is very timely. So we'll get this episode. Usually we record an episode. It takes about a week, to get up and going. We're going to try to get this up like either today or tomorrow. But as we're
Yep.
recording this, it's Thursday, December the 19th, and it's 9:30 a.m. Eastern time. And yesterday, the Fed met, and what happened?
So yesterday was a very interesting Fed meeting in that the market got a surprise, and the market really doesn't get surprised by the Fed too much because they really do a pretty good job of broadcasting what they're thinking and what they're doing. And what happened yesterday at the meeting is, of course, we got our 25 basis point reduction, which is what the market expected. We got our notice in the only very slightly changed Fed statement that future interest rate cuts were going to be data dependent. That was totally expected. Probably a January pause in the cutting of rates, also expected. And then we got the dot plot map. And that was not something that the market had expected. And so that's why we saw that reaction, which
What's a
started about 20, 25 minutes. So,
what?
yeah, so the dot plot, let's go ahead. Let's
Yeah,
talk
that's my
about
question.
that
What's
for
a
a
dot
second
plot map?
because, yeah, for kind of nerdy folks who, like me, who find the economy and some of those things very interesting, that's something that we often look at, but, you know, um, not everybody follows that. So the dot plot map is every voting member of the Fed puts a dot on where they think that the interest rates are going to be after a certain period of time, in this case, a year. And so they are forecasting where they think interest rates are going to go. And of course, these are voting members of the Fed. So these are people that have an effect on where the dot lands. And so the previous dot plot map, they don't put one out every meeting. The previous dot plot map came out predicting an additional 50 basis point cut for 2025. So 100 basis points in 2025. And yesterday, the overwhelming number of Fed governors predicted that interest rates would only go down 50 basis points in 2025 for the whole year, not 100. And this was a shock to the market. They were not anticipating this. And that's why we saw the reaction. We saw the mortgage-backed securities market drop about 60 basis points, 65 basis points, depending upon what coupon you're following, in about from about 90 to 120 minutes from when the announcement came out to the closing session. Really, probably the biggest move in the shortest period of time we've seen in quite some time because of that surprise. So pricing got worse by 65 basis points. So your origination fee for a certain rate went up, or your interest rate's going to go up an eighth and a quarter, or depending upon where you are on the rate sheet and how you have yourself constructed in terms of that. And it was a bit of a difficult day. You don't often get surprises in the Fed meeting these days, but we got one yesterday.
And I guess it's not real common that we get a 25 basis points drop in the Fed rate, and yet mortgages got worse by 65 basis points or somewhere in that ballpark. Uh,
Correct.
that that
Correct.
that would so which leads to another thing that you and I talk about frequently. And if people listen to other episodes of the podcast, they can catch some more detail of that. But it's the old question: well, gee, the Fed's going to meet this week. They're probably going to lower rates. I'm recommending to my prospective borrowers or my people that have loans in the pipeline that are floating. I'm suggesting that they float because I think the red might help the rate a little bit, and the consumer might be saying, "Hey, maybe we should hold off. I hear the Fed's meeting and they're going to lower rates." Boy, that didn't turn out so well for loan officers to do that yesterday. Hey there. Hey, if you're loving the tips so far, be sure to hit that subscribe button right down there and then tap the little bell so that you never miss out on more free cool tips coming your way. Also, I would love to hear from you. Drop a comment beneath there. Let me know what you think or tell me what you'd like to hear next.
As we all know, mortgage rates don't follow the Fed rate cut, but directionally, normally they're going in the same direction. Yesterday was a bit of an anomaly, although a difficult anomaly. But what I would say, we often talk about for loan officers, how do we position ourselves as experts? How do we position ourselves with our realtors, with our borrowers, with our past client database, with our pre-approved and looking as experts? And Carl, as you and I have talked about, when I was originating back in the earlier to mid to late '00s, I always had a heavy bias towards locking. And I always tried to get my borrowers to lock because I just thought that emotionally it attached them to me a little bit more. It protected them a little bit more. And with all due respect to all the services out there, the MBS Highway, the Barry Habibs, and I've never met Barry, but I've listened to him many times. He's an extremely smart man. I just don't like the predicting, because if you're wrong, the conversation about your rate has gone up or your costs have gone up is so much more difficult to have than the conversation about, hey, rates have dropped some, can you get me a lower rate? And there are float down options. You can call your secondary guy or gal at your company. Usually you can work something out. You usually don't lose borrowers in that conversation. But regardless of what happens, if you get a jump, they're never going to remember that it was their decision to float. They're always going to blame you. Yeah. So I always thought positionally it was way better to lock and get them in the barn and to let them float. And yesterday was a prime example of that.
Yeah. Good stuff, man. All right. So
Yep.
so it looks like we're I noticed today it looks like there was the not much is happening yet on the in the market. It seemed to be pretty hovering about where it ended up yesterday.
We opened a little bit down. I don't think that's surprising. We're going to get an inflation indication, PCE number tomorrow. There's all kinds of speculation as to whether or not the Fed gets that early. I don't think that they do, but some people do. I think kind of this is where we are with rates. And you're going to see, all through 2025, you're going to see a little herky-jerky. You're going to see some overreaction to little data points because the market doesn't really know. One other thing I would say yesterday that was important is I think the Fed signaled that they're back on the inflation hunt. In September, they kind of were pretty well convinced that inflation was on the way to 2%, and they indicated they're going to put their focus back on the employment numbers because, remember, the Fed's got two jobs, full employment and no inflation or little inflation. And they have to watch both of those things. And they switched their bias back yesterday. They're going to be concentrating on inflation. They are no longer convinced, as they were in July and August and September, that inflation is on its way to 2%. I think they're pretty convinced that it's resting at 2.5 or 2.75, which doesn't sound like a big difference. But when you do the math year over year, it really does make a big difference because, of course, inflation compounds. So I think they're back to looking at the inflation numbers, the PPI, the CPI, the PCE indicator, and that's what we're going to have over the next few months. So
good stuff. All right, Owen, thanks a lot, man. I appreciate everything you do. Hey, if you want to hear more of what Owen talks about on these kinds of topics, he's very active on LinkedIn. So if you just go to LinkedIn and look up Owen, Owen, Lee, Lee, pretty easy to find him there. So good stuff, Owen. Appreciate you always being here, brother.
Thank you, Carl. Always a pleasure to talk to you.